We are half an hour away from the open in Hong Kong, in Shanghai, and in Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: Asian stocks making gains after Wall Street's 25th record high of the year. Nvidia leapfrogging Apple to join that $3 trillion club.
Bridgewater's Ray Dalio says Chinese assets are attractively priced, even as he calls tensions between Washington and Beijing one of his top global risks.
Plus, Narendra Modi seals a coalition deal, handing him a third term as India's prime minister, despite his election setback. Yeah, a 25th record that was notched on the S&P overnight here. So it's once again maybe good news is good news. That ISM services number that we got overnight and seeing a rebound in that did actually stoke a bit more risk sentiment here, given that the last 4 days before that was basically bad news when it came to the macro front. So certainly we are seeing when it comes to stocks, we continue to see gains here in the Asia Pacific. We're up some close to 1%. U.S. futures are flat here this morning. We're also counting down that ECB decision later on today. Maybe the next to cut rates and start off with this easing cycle. The guidance might be quite telling here, whether they're just one or done, or can they actually see a clear path forward. But certainly the Bank of Canada sent things aflight here, talking about the start of their easing cycle, that more could come here. I think ING was saying maybe another 75 basis points of cuts could be in store there. So we are seeing still some weakness, well, a little bit more strength coming through, but there was weakness on the loonie as well. There has been some weakness, but we're coming back here, some strength into the Japanese currency as well overnight. Yields were actually still ticking lower in the Treasury market despite that ISM data, though. So there's still a sense that the bond market is pricing in more of that slowdown here. In fact, you take a look at, I think, yields in the 10-year. We're back to around April lows as we speak, 428 for a U.S. 10-year. We're watching jobless claims to later today, and then we got the non-farm payrolls to wrap up on Friday as well. So yields are ticking lower across Asia here today as well. We're watching the Aussie 10-year yield down some 5 basis points. And, of course, it's the NVIDIA effect once again. We talk about overtaking Apple, joining this illustrious $3 trillion market cap club. It's really helping the likes of Taipei. Look at the TAIEX here. We're close to 2% gains at the open. TSMC, I'm guessing, there you go, is contributing to that. We're up close to 4% from the early onset here. Nikkei's up 1%. I'm guessing when the Kospi reopens tomorrow, we're going to see similar gains, and we're watching very closely what goes on with HS Tech in Hong Kong. Keep in mind when it comes to these industrial metals, the energy space, we seem to find a floor when it comes to oil markets. That certainly is helping Brent here this morning. We're still hovering on that $78 mark. Iron ore and copper, though, those are the ones that have seen a bit of weakness here on concerns of demand in China. We've seen inventories pick up, not just for copper, but also in some of these ports in China when it comes to iron ore. I think it's back to around 2-year highs. So one thing to watch here today. It's still about India, though, right? So more stabilization, more calm. You take a look at how Nifty futures have basically pointed out the last 4 days after the big political shocker that we saw earlier this week. Seems like we're back to the levels that we saw before that on Friday, David. So certainly maybe signs that there is a coalition government being formed, that, yes, that third term for Narendra Modi has been secured. That maybe sends a bit more calm into these markets. We're watching India futures here once again this morning. And again, you're watching China. So it's China, relatively speaking, there's been almost like an oasis of calm, given all these geopolitics, local elections all around the world here right now. Futures are still pointing a tip higher there. You take a look at the property space, though. We saw HS Tech go into that correction. Perhaps the property gauge could be next. We're talking about bear market territory for that one, Dave.
Yeah, I like how you put that, an oasis of calm. That's the Yvonne man way of saying nothing has effectively happened in this market this week. Well, we'll see. We'll see what happens as well. I mean, it takes us into the agenda today. So certainly to Yvonne's oasis of calm, this lack of volume and turnover. So turnover yesterday onshore actually hit the lowest in about 5 months or so. So we're watching that as a metric. For 5 straight days now, we've been able to at least rely on the CSI 300 on the 50-day moving average as your support. So we're watching that closely today, although it doesn't seem like we'll need that today given the sort of up arrow story we're seeing across equity markets. In terms of sectors here, auto stocks, we have some data coming through yesterday. Prelim numbers out of the PCA, down 3 but up 36% when you look at NEV specifically. Crypto stocks, Bitcoin 71,000, and of course the Greenwich Economic Forum. We've heard from Ray Dalio, and later on, of course, I'll be speaking with Kathy Wood. And guess what? We might just talk about NVIDIA. We'll see. We'll see what happens with that. And of course, earnings coming through out of NEO and also Meituan. The agenda is packed today.
You wouldn't be doing your job if you didn't ask her about NVIDIA.
Yeah, and why they sold out so early.
Yeah.
But I think they added it back. Anyway, we'll find out.
We'll talk about that. Yeah. But yes, it really is about the central bank discussion, right? Because after what we heard from the Bank of Canada, I mean, they're the first among the G7 to really start this easing cycle. You got to wonder what the ECB is going to do. And are we seeing a central banks basically diverging from the Fed a little bit more? Or is it going to force the Fed's hand to maybe start cutting rates earlier this year?
Well, hopefully it does, so we can stop talking about the Fed. No, but that's a good point, right? Because it's clear that it's clear they'll do something today. The ECB.
Yes.
It becomes then, in fact, when you look at it this time next year, the consensus is non-consensus. Projections are all over the place.
Yeah.
Canada's maybe slightly more certain when you look at the path there. But then again, to what extent can the ECB diverge from the Fed, right? That's the other question, too. The other thing, too, that we have to talk about is NVIDIA, right? We touched on that. Yeah, $3 trillion. It's on top of Apple now, and Microsoft.
I think 5% away from Microsoft.
Yeah.
And surpassing that, and given just this relentless rally, I think we might actually get there pretty soon.
Wait, well, we did 5% overnight, so we could be a day away.
And keep in mind, I was reading some stats about this. The last time NVIDIA actually was overtaking Apple was back in 2002. That was when the first iPhone model was released, and both were only worth about $10 billion each. So it's been a while since we've seen this.
The other benefit that I've flagged from this NVIDIA rally is people have stopped calling it NVIDIA.
They finally figured out how to pronounce it.
Yeah, there we go.
Maybe we'll figure out Wanko.
Yeah.
Day two.
Well, it has to get to $3 trillion first. Banter aside.
Yeah, let's bring in our guest this hour, Joe Little, Global Chief Strategist at HSBC Asset Management. He's been enjoying our chatter here this morning and in town here in Hong Kong. Joe, it's interesting, right? We'll start with the central bank discussion. It seems like the last couple of days, I think barring yesterday, you're seeing weaker macroeconomic data coming out from the U.S. And the markets really did kind of see a bit of reset, especially in the bond market in some ways. Do you think that in this environment, are we basically past peak Goldilocks now in the U.S.?
Yeah, well, good morning, Yvonne. Morning, David. It's a great question to start the discussion, because you're quite right. There is a cooling off of the growth trends. We see it in the job openings data, in the payrolls data, that broad reading of all of the different signals that we get, gradual cooling off really coming through. And we've seen the same kind of signals playing out on the inflation side as well. So the mood today among the range of economic indicators is a little bit different to what we saw in April, the height of those inflation worries, the height of the no landing set of thinking among market participants. And like you say, that shift is having a big bearing on the outlook for policy, the outlook for the stock market as we look into the second half of the year, and the scenario for treasuries and the broad global bond markets too. We've seen a big reset around market rate expectations this year. Remember, we started the year at 7 cuts.
Yeah.
Quite remarkable. So 1 to 2, depending on which day of the week you look at the market. I think that puts the Treasury market, the short-term Fed funds futures curve, on a more sort of normal footing. It's not obviously wrong. There's more symmetrical risk to that scenario. Fed could go a little bit more, it's possible, or we could see maybe fewer cuts being delivered. But it looks more balanced. And, of course, that sets up, I think, then a better situation for core government bonds, for core treasuries, for gilts, for the European bond markets going into the second half of the year. It's been a difficult start for government bonds, but the second half of the year might be a little bit better as a consequence.
Right. So do you suspect then bonds might relatively outperform equity markets, which have done well? Is the path clear for bonds at this point, given what you just outlined there?
Yeah, so I think the advantages or the investment case for owning core government bonds at this point is based around the yield levels, which seem to be attractive amid restrictive policy. Yeah. The all-in yield, exactly, as you say. The situation that we might see continued disinflation, I think that's probably right. Okay. I mean, it's been tricky to read the picture, of course, because we've had sticky inflation and some specific factors going on in rent and other services components in the US inflation in particular. But our assessment is that inflation has been sticky but it's not stuck. And so if that plays out and proceeds as we go through the second half of the year, then the combination of the policy pivot, good starting yields, and disinflation trends, I think put treasuries, core government bonds in a better situation from a return perspective. So a return for fixed income in the second half of the year looks good.
So how are you reducing your exposure to equities now in general, or do you think this AI trade can actually keep things afloat for now?
Well, I mean, as you said on your introduction, the AI theme is unstoppable. The Magnificent Seven theme is unstoppable, at least for now. The question for investors and our own fund managers is really assessing the extent to which the expectations have now moved so far ahead of what is deliverable in the near term that it could create a little bit of a air pocket. And if you think about the valuation position of the Magnificent Seven, more than 30 times earnings compared to the 18 times for the broad S&P 500, and also the fact that we've seen such strong profits growth, which means that sequential growth, as we look into Q3, Q4, the second half of the year, that becomes a little bit harder. The relative hurdles are that little bit higher. So we suspect that what we're going to see actually is a broadening out of market performance into other sectors, laggard sectors, maybe some of the more defensive or left behind cyclical parts of the market. That's not to say that the AI story is over. That's not to say I'm not an optimist on the productivity benefits for social welfare and economic outlook, but I worry that a lot is already priced in. And we might see not just some of the other sectors in the US begin to catch up a little bit as the market broadens out, but also other parts of international equities, Europe even, Japan we continue to like as a market, and of course the Asia region continues to offer superior growth at good valuations, especially if the Fed does finally pivot.
Finally, I was going to ask you actually about Europe. Markets there have done well as well. Even the FTSE, of course, over in London. Your outlook for that part of the world?
Well, I mean, the situation in European stock markets looks okay, actually. We've had mid-single-digit returns so far.
Which is strange.
This year.
You don't normally see this group do that well.
It's something to be celebrated, right? Europe is life in the slow lane. So we take that positive return with all of the positives that it implies. Look, the reality is we're seeing better economic momentum and better profits momentum in Europe. And expectations were set at such a level that it was possible that you could get a positive surprise. So when analysts are only expecting 4 or 5% earnings growth going into 2024, and we're ending up with maybe mid-single-digit profits growth over the full course of the year, that's an important positive to celebrate. The momentum is there in terms of the economic story, and the valuation discount remains pretty significant. So Europe trades maybe about double the discount versus the US to what we typically see. The P's are much lower than the historic norms. So there is a valuation anomaly, a valuation opportunity in European stocks. And if the ECB is cutting rates, like you suggest, I think that's probably right. We probably see maybe the ECB proceeding at one cut every quarter, that sort of cadence. That is a boost not just to the European stock market, but to European small caps as well. I think you've got to be careful of the politics. And of course, as you say, the extent to which the ECB can untether itself from the Fed, or economic momentum in Europe can untether itself from global economic trends or US economic trends is an important variable to watch. But the situation in European stock markets is looking much more optimistic than it has done for a little while.
All right, Joe, thank you. We'll have more from Joe Little there, Global Chief Strategist at HSBC Asset Management. Still ahead, we're talking India and Narendra Modi securing that coalition deal to stay in power after his party's shock rejection by millions of poor Indian voters. We look at the market implications next.
Yep, counting down to the open of trade, just 16 minutes away. Cash market open. We'll get things trickling in over the next few minutes or so. Futures are pointing 0.25% higher here on futures in Singapore. Plenty more ahead. You're watching the China Show. Right, welcome back. You're just in time here and quite convenient, really. 7-Eleven is your fix of the day here. Out of the PBOC, 7-Eleven 08 to be more specific there, and not much movement, of course, in the currency. So far this week, a lot of this is really down to the fact that we are, seeing an environment of falling yields, generally speaking, this week.
Yeah. And
global yields, to be more specific.
Yeah, in particular. So that should at least stabilize the currency in China for a bit here until we get a bit more clarity, some more data out of the U.S. this week. We're still continuing to track developments out of India, where Prime Minister Narendra Modi has secured a third term in power after winning the backing of two key allies. Now, his party, the BJP, was forced into coalition talks following the loss of his majority in the parliamentary elections. A weaker Modi-led coalition government will likely make it harder for him, though, to push through some tough economic reforms. Meanwhile, an Indian opposition lawmaker is calling for an investigation into Monday's stock market rally triggered by exit polls incorrectly predicting a massive election victory for the BJP. The next day rout also saw almost $400 billion in value wiped off the stock market. But you got to wonder, right? Things have stabilized a bit, but can we return back to the good old days of India's stocks, right? That dream run that we saw leading up to this election.
That immaculate bull market that's taken PE and held PE at above 21 times. Joe Little is still with us here on set, Global Chief Strategist at HSBC Asset Management. The question is India too expensive?
Yeah, a very important question on the top of many investors' minds at this juncture, David. So part of the source of volatility I think we've seen in the market is obviously connected to the news. Yeah. But it's also the news in the context of where the market had gotten to, how valuation had moved higher, how sentiment and participation in that stock market had changed. I mean, it's interesting that we've seen the recovery in the stock market already. A little bit similar to what's happened in Mexico, actually, as well. Right. So another surprise election result there. Yeah. A little bit of anxiety in the moment, risk premia coming into the market, as the economists would say. But as quick as it came in, it seems to have dissipated again. So where does it leave us? Well, I think the election uncertainty does inject a little bit of volatility into markets. But does it change the fundamental picture? The profits delivery in India remains very strong. We've still got a very strong macro story. It's the strongest and fastest growing economy in the world again in 2024. We've still got a disinflation story and the credibility that's been built up by the Reserve Bank of India over time. From a foreign investor perspective, the stability of the rupee has been an important development as well. And as you know, the authorities have been carefully managing the appreciation of the rupee over time. So I think the longer run fundamentals continue to put the market in a good situation. Those profit expectations, mid-teens for 2024, look very deliverable against the economic trends that we see globally. And of course, you've got the structural story too. Yeah. The infrastructure, the innovation, the individuals, the three eyes of India. The demographic dividend remains an important aspect of the growth story that has been partly harnessed, but can be harnessed further by the India growth story. The watch point is the valuation situation. And part of the reason why we've had a focus more on the larger cap names rather than the smaller capitalization names is connected to some of those observations around valuation. But of course, if profits are still being delivered, if growth is still being confirmed, the market warrants trading on a stronger multiple. So I think the longer run picture, longer run fundamentals still look okay, despite the near-term volatility that we've seen.
We talked about these sort of setbacks in India, Mexico, certainly sparking this volatility. Yeah. How important is it to look at geopolitical and political risk here right now? Is this a bigger tail risk that markets are underpricing here? And how do you actually hedge it?
Well, the rule of thumb over the last 20 or 30 years is that this has been an occasional inconvenience for investors. It's injected some uncertainty. It's injected some volatility into markets. It's created a bit of a near-term problem. But essentially, political risk, election uncertainty has been a long-term buying opportunity, particularly for value-minded investors or contrarians who can take advantage of big lurches in prices. My concern is that we've arrived at a slightly different situation today, where geopolitical uncertainty is more of a feature of the economic and investment environment rather than a bug. And the individual events themselves are similar to what we've experienced in the past, of course. Elections, policy changes, industrial policy shifts, fiscal policy announcements. But the trends that we're seeing across the Western economies and also across the global South and the more powerful emerging economies in Asia, in the Gulf, in Latin America, seems to suggest to me that some of these political events start to stack up they start to become maybe individually important, but collectively really quite significantly important to watch for markets. And of course, it creates a situation which makes it very complex in terms of the economic trends and rather uncertain. But if left to their own devices, it can inject a bit more inflation into our global economy, maybe create some challenges and headwinds around growth as well, and also create some winners and losers, which is maybe the key issue from an investment perspective.
Yeah.
Because it might suggest that country-based investing, country strategies, allocating tactically and dynamically across different regions is going to become a more important way of how investors need to approach this situation. And we've seen that with Asia this year. Asia was a laggard last year, is a winner this year. Latin America was a winner last year, is a big laggard this year. So that sort of idea of rotating through different countries based on an understanding of valuations, the politics, the economic trends, the different strategies that are being pursued by governments around industrial strategy as well, that could be a really important way to start to think about investment strategy at this juncture.
Right. If I guess very quickly, if the U.S. is doing well, if India still can hold up, your allocation is going to go up to 100%. Where does that leave China?
Well, I mean, international investors are looking again at China, particularly after the strength that we've seen since the second quarter. And China's outperformance versus India has caught the attention of many institutional investors in Europe and elsewhere that I've been speaking to. I think the first shift that's taking place is many investors are moving away from an underweight stance on China, correcting that. But we're rather optimistic looking ahead over the next 12 to 18 months. The combination of macroeconomic better news. It's a bit uneven and unbalanced at the moment, but policy support continues. So I think we can expect more good news there. And the valuation discounts remain very attractive for investors in the context of global markets and emerging markets as well. So, more positive on China for the medium term at this point.
Fantastic to see you here in the region. Let's run this back to it again. Joe Little there. Thank you so much. Global Chief Strategist at HSBC Asset Management. On the positive note from Joe, positive look at markets going into the open. 5 minutes away. This is Bloomberg.
All right, some stocks to watch at the open. So these two are reporting earnings later on today as well. So we're watching very closely NIO and Meituan. Meituan's already up in the pre-market, close to about 1.5% gains or so. And we're watching some of these chip stocks as well, just given the NVIDIA effect. Seems like that's filtering and benefiting this part of the world. Hong Semi up some 4%. The open is next. This is Bloomberg.
Economic warfare precedes military warfare. American investors investing in China could experience from their government negative consequences for that. And then there's also the worry from that the Chinese side could make that challenging. There's a great risk of economic sanctions, an exchange of economic sanctions that would be really terrible for the world. So there's risks behind that. At the same time, Chinese assets are very attractively priced, and we've done very well. Bridgewater has done very well over the last 5 years of operating in there, and so there's certainly effective ways to make investments in China.
That was Bridgewater Associates founder Ray Dalio. They're speaking at the Greenwich Economic Forum. That is happening here in Hong Kong. So certainly there's a lot on tap there, coming through some good conversations from the likes of Dalio, talking about these U.S. elections, the China conflicts, and the global risks out there. And really what we're seeing across these markets is still this rally in China seems to be picking up again.
It has, and I think the tailwinds, to your point, Yvonne, coming through out of this global risk rally we're seeing that started in the U.S., certainly the NVIDIA story, which we'll get to in a moment. And speaking of, by the way, so Greenwich, so right after shows, I'm headed there, of course. We're speaking with Kathy Wood. Annabelle is actually speaking with the Alibaba.com president. So good conversations coming up. At the open, your heavyweights, bottom of your screens here, on the onshore market. Although we're watching turnover specifically, I'll show you a chart in a bit. That points to maybe that just starting to come off as well. The figure yesterday on turnover was the lowest since about January 30th, so right before Lunar New Year. 0.4%. At least price has been keeping up. 50-day moving average, by the way, is the one in focus today. Right, flip the boards, have a look at Hong Kong. A couple of things here. So the bear market might be near, maybe not today. As far as the property stocks are concerned, that's point number one. Point number two, this risk rally is lifting most boats, if not all. HS Tech Index is up 2%. We're going into, I want to say busy, but you do have some big companies coming out with earnings today. In fact, you have Meituan rather. Meitu's a different story, but you also see Meitu coming up next, I believe, on the back of this pickup in crypto stocks. Flip the boards, please. And also NEO out with earnings as well. There's also this Reuters report talking about how NEO was given the green light for its third factory in China. Henderson Land, reason we're looking at this right now, big drop in the stock yesterday of about 7%. We're stable as we speak right now. And there we go, as promised, Meituan and Meitu with Bitcoin at, what, 71,000 or so. Right. Bear market, property. We talked about this, okay? So from May 17, roughly, that was the peak on the property gauge. Since then, we've certainly come down. We're down about 18% from that point. So we're on bear market watch, if you will. Change the board, please, if we can, and just show you how far we've actually come down. So we're watching that very closely. Do we have that? Thank you so much. There we go. So not as much. From that peak to about here, that's about 18%. Okay. The other thing we're talking about as well is this NVIDIA effect. And I believe we have that. If we can show that, please, the chip stocks. So SMICs of the world. In your pre-market, we're doing very, very well. Here we go. So 4% up. Sunny Optical is also getting a bit of a boost. So the story there, NVIDIA has now become, in the rare event that you probably missed it, now the second most valuable company in the world. Okay, that's the story there. Very quickly, I promise you turnover, and I'll toss it back to Yvonne right after this. So yesterday, the turnover in the mainland China was that level. So that's about 700 billion renminbi. Take you all the way back to, as promised, January 30. We'll see whether this picks up. Fun.
Yeah, it's interesting, though. You mentioned about, we were just talking to Joe Little from HSBC. The fact that we've seen these sort of big reality checks in India, in Mexico, for example, with these local elections, does that give China, relatively speaking, look a little bit more stable? And these two markets were the ones that really kind of did a lot of the heavy lifting when it came to EM for the past few years. Is there signs of a change now? And certainly that's one thing we're watching from Bloomberg Intelligence here. They have their EM scorecard that came out just this morning. And really, they're talking about mainland China stocks that have momentum on their side, but they will need policy support as earnings remain a drag. Our China equity strategist, Marvin Chen, joins us now with that report. So where does China rank in this whole EM scorecard now, Marvin?
Well, China is still kind of at the lower end of the scorecard, but has moved up over the recent quarter. As you mentioned, one of the key concerns here is the earnings outlook, which remains relatively more uncertain than the rest of the region. I mean, the rest of the region, we've been seeing positive revisions over the past 12 weeks or so, but China is kind of lagging on that front. But we are seeing signs of stabilizing, particularly after the tech earnings that came out mid-May. But we want to see that kind of positive revisions in the tech sector kind of broaden out to the rest of the market.
Yeah, so your scorecard is on the screens here. Favorable markets, Vietnam, EM markets, Korea, Turkey, and Taiwan. Just talk us through what perhaps, is there a common thread between those that are doing well? Is it an earnings story? Is it something else?
Yeah, so Korea, Taiwan, obviously very tech-heavy markets, but they're at the top of the scorecard for kind of different reasons. Korea has the valuation is a valuation play right now. After the China rally, Korea is actually now the cheapest market within the Asia region, and regulators there are still working to kind of bring out that value with the value up program. Taiwan is more of a momentum play, obviously, with NVIDIA. If we look at the past 5 or 6 quarters, the correlation between Taiwan and NVIDIA earnings announcement and guidance is increasing. So, as long as the AI theme momentum is there, Taiwan can continue to perform. But we do want to note that valuations are kind of getting stretched in that market.
What about Vietnam? It's interesting that's one of your favorites. Southeast Asia has kind of been overlooked in a lot of this part of the year, but yeah. What's going on in Vietnam? I think we're near 2-year highs for that market too.
Yeah, exactly. So Vietnam, I mean, technically it's still a frontier market, but it's kind of moving towards becoming an emerging market. But it is one of the beneficiaries of the China Plus One strategy. Vietnam, along with India, we're seeing supply chains kind of shift towards Vietnam. A lot of foreign direct investment, and the growth there is just supporting the market in terms of valuations as well.
You mentioned India, so I need to ask you about India. Well, obviously, given the news flow this week, number one, and your scorecard, the market doesn't seem to be ranking very highly.
Yeah.
Even going into a week like a fairly turbulent week like this week.
Yeah, so I mean, we've seen most of Asia move up our scorecard with the exception of India, which has kind of fallen a few notches. The main driver is that we've been seeing outflows, foreign equity outflows over the past several months leading up into the election. So I mean, some of this may have been prudent given the election volatility that we've seen this week. And we think obviously with the new government in place, it'll take some time to settle in and get back to kind of the reforms that are necessary to keep this structural growth story in India continuing.
We mentioned about China. I mean, obviously, we've been talking about the momentum there. One thing, a trend that seems to be emerging is these issuance of convertible bonds. And you're seeing a bit of a boom in some of these tech plays, yeah. Alibaba, Trip. Why do you think they're doing this now?
Yeah, I mean, I think the convertible bonds is something we're going to see more of. And there's several reasons why we think it makes sense at this time. One being that, the market sentiment on equities has improved, so there is demand for China equities now, and therefore these convertible bonds. Two is that, the offshore rate outlook, the Fed outlook has changed dramatically over the past 6 months, and so now we're into this higher for longer period, and these convertible bonds will provide cheap funding for these corporates. Lastly is, there's concern on the dilution effect of these buybacks and near-term stock volatility of the convertible bonds, but we want to note that some of these funds are being used for buybacks, which can help offset the dilution effect. And these buybacks are ongoing at the moment, while the potential dilution will be sometime in the future at a 30 to 35% premium.
Okay. There we go. Marvin, fantastic. Thank you so much. Marvin Chen there, our Bloomberg Intelligence China equity strategist. Just ahead, a curtain raiser on earnings coming through today. So you have NIO and you also have Meituan coming through. So a preview of both just ahead. This is Bloomberg. Right, about 10 minutes into the session, we're looking at auto stocks. So NIO, we talked about this. We'll get to this in a lot more detail in a moment. Earnings are coming out. You had some data coming through, prelim numbers out of the Passenger Car Association late on Tuesday. So overall sales are down 3%, although when you look at EVs specifically, we're up by about a third year on year. So it's unsurprising we're seeing that part of the market, of course, doing quite well, of course.
Yep, let's get back to NIO now, and really set to drop its first quarter earnings later on today. Bloomberg Intelligence is forecasting only an incremental rise in revenue. I think it's just about 0.7%. For more, let's bring in Katrina Nicholas. She leads our Asia transport coverage. And Katrina, what are we expecting from these results?
Yeah, that's right. I mean, analysts are looking for a sales rise of sub 1% for NIO, and this reflects the discounts and the drop in deliveries that they've been having. Sales were back above 15,000 units in April, and potentially we're expecting management may guide the market to something like second quarter deliveries above 50,000 units. But really 2024 for NIO is a key year in its efforts to become profitable. This is an unprofitable company. It's never made money. And having initially focused on the premium market since it was founded back in 2014, had all these high-end club-like showrooms and private houses that were called NIO houses, and a very cost-heavy battery swapper operation that it rolled out in China as well as in parts of Europe. The company's really taken a step back. They've reined in their spending over the past year. They've slowed down their overseas expansion, and they're cutting jobs. So this has helped improve its margins a little bit. Margins used to be up in the low double digits. They've swung right back down, only sort of 5% last quarter. we're expecting perhaps that will rise when we get earnings from them later this evening to low single digits, still not above double digits. So it's a story of turnaround that we're expecting, but a slow turnaround.
And you discussed the cut in spending, yet we have these reports, and maybe this certainly probably makes sense, if not definitely makes sense from a company perspective, that NIO is actually looking to explore a third production plant in China. Now, the backdrop here, as you just laid out, sales growth is wanting. You have international capacity, for example. You have these tariffs in Europe. You had the story related, maybe the Great Wall Motors is shutting its headquarters and offices in Europe. Is increasing capacity at this point in time a good thing? Is the question, I guess.
Yeah, well, I think that's a really good question. So we have had confirmation this morning that NIO has started construction of its third electric car factory in Hefei. Now, that's the same city where it has its first two existing factories, and NIO has said, those factories have actually reached their design capacity, and based on the sales forecast that at least NIO sees, they do need another factory. So this factory that they're building, they've broken ground on already. It's designed to run in a single shift, like its first two factories, and have an annual capacity of 100,000 cars a year. Now, this factory will service both the NIO main brand and also a newly launched brand that they've had, Onvo, which by all accounts is doing reasonably well. One of the reasons is because consumers are sort of snapping up its ET5 sedan, which goes up in direct competition against Xiaomi's SU7 car. And that's been hugely popular. Lots of social media buzz about that one, but very long wait times. And so consumers are sort of plumping for, a car that still looks very good, has some of the same specs, but is available in a much shorter time frame. It's interesting also, you mentioned the EU probe, and of course we're waiting to see what tariffs might be levied against Chinese automakers. But there was an interesting report just out yesterday from Alex Partners about Saudi Arabia and the EV boom there. And that, a lot of Chinese car makers have been going pretty heavily into the Middle East, Abu Dhabi, Dubai, Saudi Arabia as well. And this report sort of found that the Chinese EV brand awareness in Saudi Arabia is way higher than it is in parts of the US, Europe and Japan. So even though, counterintuitively, you'd think maybe a third factory is not the best idea at this point in time when EV sales growth is slowing in many parts of the world, I think the one thing you've got to remember is that there are pockets of pretty explosive growth in markets like the Middle East and also parts of Southeast Asia like Thailand.
Katrina Nicholas there, who leads our Asia Transport coverage. Thank you so much there on a preview and really just context on the NIO story. From one earnings story to another, Meituan also comes out today. Bottom of your screen, stock is up 0.6%. That's a story also maybe of revenue growth decelerating, although at the slowest pace since mid-2022. Catherine Lim, who covers the stock and the sector for us at Bloomberg Intelligence, joins us right now. Catherine, should we be at all worried about the slower revenue growth out of the company?
Well, David, it's still going to be a double-digit revenue growth. Obviously, we are past the 30% year-on-year revenue growth for this big food delivery giant right now. So I think market is now looking at your mid to high teens revenue growth. Still a good, decent set of numbers. And maybe what the market will be scrutinizing will be on the margins side, because the company have actually seen, margins pressure as they continue to actually put in more user perks to try and fend off the competition like you're doing, increasingly coming from Tencent's video accounts too, which is giving users the options to actually do food deliveries, as well as some of the local services offerings that we're seeing in China. So that is what we probably should be looking at for Meituan, at the profitability of the business going down the road.
Yeah, you talk about those margins. I mean, we're seeing intense price competition in the e-commerce space in China right now, Catherine. Can we say the same for the local services business that Meituan is in?
Right. Yeah, Yvonne, what is China without competition, right? So we are also similarly seeing, the local services, whether it is food delivery or even travel offerings out there. There is price war inevitably going, around China right now, and particularly as we step into the summer holidays. So we've also seen, Meituan putting in the necessary perks and offerings, tying up with their merchants to try and retain the users. So that's the part that will likely continue to actually erode their margins. I think worth noting is that if we actually look at what Alibaba's Ele.me, which is also the local services arm of the unit itself. Now, the good news for Meituan on that front is that Ele.me is now focusing a little bit more on profitability versus, chasing after the top line growth. So that's a little bit of relief for Meituan, but I don't think it's going to be enough to actually, bring them off that competition that they are facing from Douyin, as well as the other platforms.
Catherine, thank you. Catherine Lim, our Bloomberg Intelligence senior analyst, on what to expect out of Meituan later on today. We got plenty more ahead. This is Bloomberg. Yep, this risk rally continues here, and China seems to be joining in here just about 20 minutes into the open, and we're watching very closely what's really going on, not just with CSI 300, but also this interesting outperformance in some of these utility stocks as well.
25% year to date, and the latest leg from about early May 20-ish has really led to this, I guess, the questioning right now, can this actually continue? So on a benchmark basis, we're actually near a decade high, and certainly will be tested now over the next few months or so when investors then start to scrutinize whether conditions are sufficiently conducive for growth. To help us understand the situation, Abhishek Vishnoy, our Asia Equities reporter, is with us right now to talk us through it. Abhishek, we know that the group has done well. We're trying to gather what the next catalyst would be, and could that actually be the third plenum coming up in a few weeks?
That could be. I mean, investors are looking for all sort of details to come in from third plenum. And it's important because, like you said, utilities are having their possibly one of the best years in recent times, 25% up. Names like CG Power, China, Yangtze Power have done pretty well on hopes that there would be wider, deeper reforms in the sector. Also, some of the companies have carried out price hikes, so that has helped. And, the whole hue about SOE reforms have also helped the sector. But if plenum comes short of details, then then there might be some profit booking in line with what we are witnessing in the broader China equity market after forming a bottom in January.
So what are going to be those clues that we need? What kind of details are investors looking for to get from this plenum now?
So there are 3-4 key things. First is China has the peak carbon emission target for 2030. So what kind of usage of renewable energy is the government looking at? What are the plans of the government in that context? How much investments would be lined up for grid and storage capacity? That will be very important. That's one thing that has been the underlying factor in this rally. Apart from this, any more color in terms of pricing, any more color in context of where that is headed would also help the sector. Most of the guys that we talk to, our reporting is showing that rally is most likely to continue, and plenum is unlikely to disappoint, at least for this sector. And there might be more details coming in on grid equipment and storage. So stocks tied to those sectors, at least grid equipment and storage, they might extend their recent gains.
Abhishek Vishnoy, thank you so much. Our Asia Equities reporter on this utilities rally that's, pardon the pun, powered ahead. Cement, Asia Cement, this is one very much in focus, and we'll talk about chips and we'll talk about the broader markets quickly after this. So 8% down, taking private deal the price is at 322 here, so we're, I guess, below that price at the moment here. The parent, of course, is planning to take the company private is the conversation. Right, chips, NVIDIA, there we go. Nothing much to say. GMM. Let's have a look at the global macro movers for you.
Yeah, I mean, it's one word, NVIDIA.
Yeah.
That's what's going on there. NVIDIA is probably why you're seeing a lot of green across their GMM here, with Taiwan really leading that charge. TSMC, they're like really kind of benefiting from this $3 trillion market cap in which NVIDIA has reached overnight. There you go. So 2% gains for the TAIEX. Nikkei also. We'll see how the Kospi fares tomorrow when they reopen. I'm guessing there's going to be a catch-up trade there. Dollar seems to be on a back foot, though, so that certainly is helping risk sentiment overall. Commodities seem to be bid up, so a bit of recovery in copper prices, iron ore here today, even oil prices, which we've seen maybe a floor has been reached after a few 5 days, I believe, of declines there. And sovereign bonds continue to be bid up. That's despite that ISM services number that did rebound and you know, really showed that maybe last month's data was a bit of a blip when it showed things were in contraction. But still, this bond market, there's a bit more repricing going on now, I think.
In fact, our next guest coming up on shows is Anastasia Amoroso, and she actually says when you look at those PMI numbers coming through globally, she thinks we're entering this, on average, 9-month expansion in terms of global manufacturing. And she says, lean into risk. So that conversation's coming up. Here's a look at Shanghai CSI 300, 0.3% to the upside. Plenty more ahead here on The China Show.
Welcome back to the China Show. Here's a look at the Hang Seng just a half hour into the session. It looks like, there you go, 1% gains for another day. And certainly it's a big sign that maybe the market is less concerned about some of the macro data that we've seen. Obviously, that ISM services number that we had last night from the U.S. did suggest maybe the economy is not slowing down too much. That's why we're seeing stocks bid up, NVIDIA at $3 trillion market cap. And certainly that's benefiting the tech sector here today, Dave.
Good news is now good news, right? And a future bad news might be good news, because that means maybe central banks might start reacting in that way, right? We're up slightly, as Yvonne is pointing out, on thinner volumes, though. Turnover is in focus, of course, on the mainland after, what, a 5-month low on the value of shares traded. Okay, let's flip the boards, please. Asia ex-China. You don't have Korea, of course, trading today. It's Memorial Day there, although, as Yvonne is pointing out, we're probably going to see a massive catch-up in Korea tomorrow. So Nikkei is doing well, 1.2%. The TAIEX is there you go. The TAIEX is up 2%. TSMC's now hit, again, a new record. We are losing count on the number of times it's done that. So far, Brent crude is catching a bid finally, and iron ore, as you can see, is now at 106, 107, so certainly has come down a lot, as have yields, too. Right. Okay, central bank watch. So what is on the agenda today? It's the ECB. They will likely cut. It's almost all but guaranteed. The question is really what's next for the ECB. It becomes murkier after today.
Right. We had a pretty interesting story that was talking about the inflation challenge that Europe has, and maybe actually have similar sort of characteristics as the U.S. in some ways. So you got to wonder, you know, after this potential cut, is it really just going to be a one-and-done sort of thing? Because the path afterwards seems to be less clear now of what the ECB can do. Yeah.
Beyond September, I mean, maybe you could still make the argument for September. And then, you know, our Bloomberg story actually, and this is not a plug, it's a really fantastic graphic there where you look at it this time next year and the consensus is all over the place, right?
Yeah.
So a lot can happen in 12 months as far as Europe goes. The Bank of Canada cut yesterday.
Yeah.
And the path there looks clear from the Bank of Canada.
Oh, yeah. I mean, they signal more to come. You know, I think ING was saying 75 basis points more in the back half of this year. Maybe things there are a little bit different than Europe and the Fed, but certainly the Fed meets next week as well, along with the BOJ. It'll be interesting to see the Fed. How do they look at this, right? If other central banks across the G7 or DM are starting to cut rates now, does it push them a little bit more towards those cuts? I mean, the market seems to be pricing that in this week. You could see maybe earlier, as early as maybe even September now.
We're back to 2 again, I think. And it's going to be the first briefing, I believe, of Jay Powell post the meeting. Remember, he pushed back so much on rate hikes, the last press conference, and then the minutes came out, and quite clearly they discussed it and brought it up. So let's see how he squares those two things as well. Also, the big story we talked about is TSMC. Everything in China on chips is going up mostly. This NVIDIA effect, $3 trillion.
It's nuts.
Yeah.
We were talking to HSBC Joe Little, right? At some point, the valuation is going to be too high for them to deliver on earnings. We haven't quite got there yet. But we talk about them surpassing Apple. I mean, it's been 22 years, sorry, since, you know, NVIDIA actually surpassed Apple when it comes to market cap. And that was back when we talked about the iPhone 1 was just released, or before that.
The iPod.
So the godfather of AI still remains intact,
Yeah.
I would say.
Are you envious now, right? The Latin word for envy.
Envy is
Yeah.
NVIDIA. Yeah.
Or was it Nvidia? I'm kidding.
And I think Computex really helped this week. All the news that we got from there about this whole Rubin, these new AI chips, it's just only been months since they announced the Blackwell chip, and now they're talking about another one.
Okay, so 5% away now from Microsoft. Right, so what does it mean for risk assets?
Yeah, let's bring in Anastasia Amoroso, Chief Investment Strategist at financial technology firm iCapital. She's in town this week. It's good to see you back in the region, Anastasia. You're talking about leaning towards risk, despite maybe some of the macro weakness we've seen this week of late. Why so?
Yeah, that's right. I think there's a lot of reasons for optimism actually around the world. And, to start in the U.S., the U.S. consumer is still very strong. And the economy, even though maybe the first quarter GDP estimates were somewhat underwhelming, it's actually the core consumption is really quite strong. The second reason that I see for optimism around the world is this upswing in global growth and also global manufacturing. And we got that data this week. For example, manufacturing, whether you look at Taiwan, Korea, China, Europe, U.S., you see a broad upswing, and this is not just a one-month trend, but we think this is something that on average lasts about 9 months. So that's a different reason for optimism that tells you that it's not just a one-engine U.S. consumer-driven global economy. And then the third reason, Yvonne, if we look at rates across the world, there's an easing bias for central banks now. Clearly we're expecting the ECB to cut rates, but also even in the U.S., you look at the 10-year Treasury note, for example, went from 4.6% to 4.2%, 4.3 this morning. So that sets up a much better risk environment for assets.
What do you think about this rally in tech, semiconductors specifically? Too expensive, or can it go further?
Well, it is expensive, to be sure. If you look at the semiconductor, forward P multiple, it's now trading at 30 times versus 15 times that it was at just a few, months or quarters ago. So it is expensive, just if you look at the multiple level, but I do think it's justified. And it's justified, I would say, for a couple of reasons. Obviously, justified by NVIDIA's revenue growth. It is justified by the AI momentum, but it's also justified by the secular and cyclical opportunity within semiconductors. Obviously AI is, being the main mega trend, but there's also electric vehicles, there's also automation, there's a number of other things that require a lot more semiconductor content. But then there's also the cyclical part of it. This upturn in manufacturing I talked about, it's actually quite important to the semi trade, because as manufacturing picks up, it also historically coincided with a pickup in semis as well. And we see the inventories being drawn down. Demand is strong. So I don't think it's a coincidence that we're seeing those new highs in semis.
If it's going to be a global manufacturing sort of upturn that you're projecting, what markets do you think, or what asset class will benefit the most? Now.
So we should talk about the sectors and also the countries. From the sector perspective, it's consumer discretionary, it's industrials, and it's also the semiconductors. So that's why we've been advising clients construct a cyclical basket to really benefit from that. And then from a country perspective, it's places like Japan, it's obviously Taiwan, Korea, but it's anybody that in China that's really geared to the manufacturing, the electronic component part. So, and if you look at earnings revisions, for example, Japan has seen some of the best earnings revisions, and then also followed by the European Union. So, Europe is something that doesn't often get talked about as the top investment idea, but I actually also really like that space right now.
How big of a risk? I'm just looking for something to worry about. Our previous guest in the previous hour talked about inflation. Sticky but not stuck. Should we still worry about inflation? Has that receded somewhat?
I really do think it has receded. And, obviously, it is stickier than maybe the Fed or the ECB would like. But I think there's this realization by central banks they can only control so much. And what they can control is the demand side of inflation. They can't really control the supply. And so when you think about it from that perspective, there's some good news in the United States, because we have seen the job openings come down quite significantly in the U.S. to 8 million, which is really close to pre-pandemic levels. And it now means there's 1.2 people unemployed per job or 1.2 openings per unemployed person, and that's a much better ratio than we have seen before. So the Fed has been successful at reducing demand for labor, reducing demand for housing, but what needs to happen in the meantime is supply needs to catch up, and that takes time, but I think it will happen.
You're in town for your own conference when it comes to private markets. I mean,
Yes.
how much of an allocation should investors have when it comes to private markets now?
Right. Well, institutional investors have close to 40 or 50% allocation to alternative investments, including private equity, private credit, and hedge funds. But when we look at the private wealth channel, which is really, a lot of our client base, the private wealth is allocated between 3 or 5% to private markets. So it's really a small starting point. But we think to really move the needle and to really realize the return potential of alternatives, you need closer to a 20% allocation. So there's a big gap there in between. And, I call it an aspirational gap. It's something that I think investors are trying to get to. But historically, it's been lack of product availability, lack of access, lack of technology, lack of education. But those are all the things that we're trying to solve for at iCapital.
Have the ticket sizes come down? I mean, there's probably a reason why it's mostly still institutional. Compared to the wealthy, those are wealthier, of course, pools of money. And I'm wondering, the accessibility, has that improved?
Yes, the accessibility improved a lot because that's exactly right. If you were an asset manager and you worked with an institutional client because that institutional client was able to make a large contribution, millions of dollars, hundreds of millions of dollars. But if you look at the technology like we have, we are able to aggregate a lot of smaller ticket sizes, and we still can face off with an asset manager with an aggregate fund that is large enough. So as a result, a lot of private wealth clients are able to write much smaller ticket sizes and still participate in things like private equity, private credit, and real estate.
How do valuations look in that space now? Is it getting expensive? Or?
Well, it's interesting because valuations have lagged a lot in private markets. And so when we've seen this massive equity correction in 2022, that it really did not play out in private markets. It did play out, however, in private markets in 2023, in early part of 2023. We did see those valuations come down. But when you look at it today, they're right back up there. They're in line with public markets. They're back to levels last seen in 2022, 2021. So, that seems like that may be a negative and not a great entry point. But I will say that if you think about the value creation for private equity, some of it comes from multiple expansion. Some of it comes from financial engineering or leverage, which was cheap. Now it's not. But a lot of it, the big chunk of that, comes from operational improvement. And so that's the part that I think is more important as ever and still a big lever that these fund managers can pull.
And what is that? So you mentioned 20% as aspirational because that is what, in some ways, economies of scale in terms of what it achieves for a portfolio. What is the role of alternatives? Is it income? Is it a hedge?
Right.
Clearly uncorrelated to some extent.
Right.
But,
Well, first of all, 20% is an allocation, not just a number that sounds nice, but it's a number that you arrive at when you try to optimize the portfolio for the highest risk-adjusted return. And so that gets into your question, what is the reason to add alternatives to the portfolio? Well, there are three reasons. Either because they give you a potential for greater return, and that's why I include things like buyout, private equity, growth equity, venture capital. The second reason is because they give you potentially higher level of income. And that's why private credit is so talked about and so liked right now, because if you can get 10 to 12% yields in private credit, that's a huge complement to anything else that you might be doing in your fixed income portfolio. And then the third reason you allocate to alternatives, because it does give you low correlation and diversification with the rest of your portfolio. And to be clear, private equity is still going to be correlated to public markets. But when you think about real assets like infrastructure, or when you think about hedge funds like macro hedge funds, for example, that's the true correlation benefit to the portfolio. So that's why, David, it's hard to do all of that with a 3 to 5% allocation. That's why it really makes sense to add close to 20 to really realize those three benefits.
Fantastic having you here, and let's do this again next time you're in the region. Of course, Anastasia Amoroso, the Chief Investment Strategist at financial tech firm iCapital. Okay, here we go. Speaking of bad news, bear market.
Yeah, so we've hit that 20% drop from the May highs when it comes to this property stock gauge. You take a look at what's been going on there. Of course, this is after we saw what happened in the tech space, but that's seen a bit of recovery here. It's interesting enough, we heard from Fitch Ratings just this morning about this report about they're still thinking new home sales is going to be declining some 15 to 20%. this year. Sales trends are saying it's still missing estimates.
Right. This is going to take a while to solve itself, right? Yeah. So, we tend to get caught up in the news. Thank you so much, by the way. We're doing our job. Activity picks up, people start surrounding these brokers, and then you get, people forget this group of stocks, some of these guys are up 100% from the low. So you're still up. Anyway, we'll continue to track this story, of course, moving forward. We're talking geopolitics next here.
Yep.
Yeah.
After Ray Dalio flagging the so-called economic warfare between the U.S. and China as one of his top global risks. This is Bloomberg.
Political risk, election uncertainty has been a long-term buying opportunity, particularly for value-minded investors or contrarians who can take advantage of big lurches in prices. My concern is that we've arrived at a slightly different situation today, where geopolitical uncertainty is more of a feature of the economic and investment environment rather than a bug.
Joe Little there out of HSBC Asset Management. So he was here about an hour back, just laying out really the rationale behind why perhaps now geopolitics is something to certainly consider as you allocate your assets.
Yeah, and we heard that not just from Ray Dalio, what you heard at the Wealth Summit yesterday when you were there as well. But let's talk a bit more about what Ray Dalio did say. He's talking about U.S. elections and the risks around there, and the growing tensions between Washington and Beijing are among the most critical issues right now for investors. The Bridgewater Associates founder told a Hong Kong forum that economic warfare can lead to military warfare. For more, we're joined by our China correspondent Min Min Lo. Tell us a bit more about what Dalio said.
Yeah, I mean, geopolitics, it was like at the forefront of two different economic conferences yesterday that was held here in Hong Kong. So Ray Dalio was talking about how internal politics, internal conflict in the U.S. could be a very big factor, especially with the elections coming up. If both political parties cannot agree on the outcome of the election, except, of course, their common unity against China, that is a major risk, especially with the U.S.-China tension. And he's not, he's still putting his bet on China, though. He talked about how China is one of the few countries that are that is a big player when it comes to revolutionary new technology, and that assets in China are very attractively priced. But you have to diversify everything, your asset classes, your countries, your currencies. He also talked about how although a conflict with China over Taiwan is not an imminent threat, but the one China policy may not continue forever, and so investors who have exposure to China could be affected. Have a listen to what he said.
Economic warfare precedes military warfare. American investors investing in China could experience from their government negative consequences for that. And then there's also the worry from that the Chinese side could make that challenging.
Yeah, and geopolitics now is that filter that every investor and business is kind of making their decision against. Because, I mean, if you talk about prime example today, the Dutch and Taiwanese chipmaker plans to open up a plant in Singapore, that's all about hedging their risks. And also these so-called neutral countries in Southeast Asia, also in the crosshairs with the Chinese solar maker planning to halt production in Southeast Asia because of these trade barriers from the U.S. as well.
So it's really picking up, and I think you make a very good point, right? So you look at the assets that are doing well. So NVIDIA, that's one. Joe Little, we were talking earlier, right? This AI thing is a way that people are hedging against the geopolitical risk, right? We were speaking with Ben Wei yesterday out of Macquarie. Their longer-term outlook allows them to be agnostic to political cycles somewhat, so alternatives are doing well. And you mentioned, of course, these two conferences. I was there yesterday at the Wealth Forum, and interestingly enough, everyone wanted to talk about something else, but almost every panel brought up geopolitics as a key risk. In fact, let's hear from some of those key voices, of course, that we heard from our Wealth Summit yesterday.
Geopolitical risks and the possibility of a tail risk event has gone up dramatically. So you
believe that?
Yes, and as investors, we should not ignore this. The biggest question for you as an investor is, can I hedge against it? And unfortunately, there the answer normally is no, because it's either too expensive, you miss out on the upside. So what you can...
And impossible to time.
It is impossible to time. The only thing you can do is prepare. Do not try to predict.
Geopolitics are definitely a big concern for ultras, not just in Asia, but across the world. I think the conflict in Europe, the conflict in the Middle East, and the superpower tensions are definitely leading to clients being concerned. That concern is leading clients to look for the safest and strongest financial centers, but also the safest and strongest financial institutions.
Yeah, and we're only in June, and we're not. This year of elections isn't over, Mindy.
Yeah. Elections play a huge part as well. We already see how it's shaping markets, especially with Modi's election.
Yeah.
Exit polls missing the mark, and then he lost the majority. It's triggering a slump in markets. And then Mexico as well, with the landslide victory of the ruling party, raising concerns of increased state control. And then you have all these conflicts everywhere. It seems the Gaza conflict, and then Ukraine, and potential tension in South China Sea, where much of the world's trade passes through. So all these are potential disruptions to supply chains.
So, and you're talking about maybe potentially two different trade wars that are going on, right?
Yeah.
If it's high-end manufacturing, certainly we talk about that a lot. Even in the low-tech exports, you're starting to see that. What are we seeing there?
Yeah, I think that's something important to point out. It feels like something quietly brewing, because there's been a lot of focus right now on all these tariffs on the new growth drivers, your EVs, your solar cells, your batteries. But China has been also ramping up a huge surplus, near record surplus on all manufacturing goods. And I'm talking about the traditional industries like your steel, your animal feed. Their exports of soybean had hit nearly 5 times of last year in the first 4 months of this year. And China traditionally is an importer of soybeans. So that's really speaking to how all these goods are, it's very hard to get them consumed in China because of the weak economy and the prolonged property crisis. And this combination of soaring exports and cheaper prices is a very dangerous combination, because it could trigger reactions not just from the US and EU, but also the emerging markets. We already see Latin American countries increasing tariffs on Chinese steel. Countries like Thailand, Saudi Arabia are considering to take similar steps. South Korea, India, they also put tariffs on certain Chinese manufactured goods. So this is something to look out for as well, a potential trade war on both fronts as low-tech exports pick up as well.
Min Lo, thank you so much. Our China correspondent there on just getting us up to speed on just this confluence of geopolitical news coming through. Plenty more ahead, and we'll look at markets coming up. We're just coming off highs a little bit, still higher for the data overall. You're watching The China Show. Welcome back. NetEase is one stock we're tracking now very closely. So it looks like this announcement, and I'm basing this on this Weibo post, which has a timestamp of 10 a.m. So it's looking like it just came through as well. So the Warcraft in China is being relaunched. We're up 3.2% on the. What's the name of the game?
Oh God, okay. Sorry to all the gamers if I butchered this.
Yeah.
It's World of Warcraft: Wrath of the Lich King. So in June, that's when they're going to be relaunching that after a test. So that's why the market is cheering on this news that Warcraft coming back.
What's a Lich King?
To the mainland. I don't know. I know World of Warcraft, though. I've heard of that. So here, look at when it comes to these chip stocks. It still remains to be one of the top stories given where NVIDIA is right now. So really benefiting across some of these Japanese, Taiwan, China chip plays as well. TSMC, there you go, up 5%. That's a record high that you're seeing when it comes to TSMC once again. And property, though, that's perhaps the other story that's heading the opposite direction. So bear market for this gauge, and certainly it seems like, I think May 17th was when we heard about these property measures, the support package. It took all but, less than a month for people to get a little bit more doubtful about how useful these policies are.
Who would have known my birthday would be the turning point to this property market story? But then again, that might just be a coincidence. Fitch coming out, and as Yvonne is pointing out, lowering their home sales forecast as trends miss estimates there. Plenty more ahead. This is Bloomberg.
11:29 a.m. in Tokyo. Japanese markets are going on a break in just a minute or so. It looks like when it comes to, of course, this rally that continues here across Japanese equities, we're up close to 1% on the Nikkei, and some strength coming back into the yen, although we did lose a little bit of ground overnight, but we're still hovering on those 155 levels. Certainly when yields are lower in the U.S., that definitely relieves some pressure for the BOJ as well. And we are below sub 1% for your Japanese 10-year yield.
Yeah, and Asia ex-Japan is up 1% following another 1% jump, in fact, yesterday. So you just do the math there on those 2 days. And it certainly underscores this return to risk, this embracing of risk assets we've seen really since almost this time yesterday. Certainly the move up overnight in chip stocks is really being felt across the markets where you are getting that chip representation. Sector-wise, and to that very point, your first row on your left, Asia-Pacific Info Tech Index is up 2.5%. So where you have the TSMCs of the world, that's at a record high. We don't have Korea trading today. That's going to play some catch-up tomorrow, barring, of course, any surprise and opposite moves you might see these next 12 hours or so. ECB's coming up, more on that in a moment. India futures are doing this, and we are trading at 7/10 to 1%, plus some of the ETFs traded all across the region. So maybe a sigh of relief. And at these levels, we're pretty much back to levels off on Friday, where we went into the weekend. Massive move up on Monday, overly enthusiastic, certainly with the information available at that point in time. A correction and then some more on Tuesday. Stable yesterday. Maybe upside going into this Thursday session, and what's really been a very eventful week for investors in India.
Yeah, and the latest really has been with the Prime Minister Narendra Modi securing that third term in power after winning the backing of two key allies. Now, the election is also the topic of today's Bloomberg Big Take, and why some voters are frustrated by an economic boom that has left 600 million residents behind. Our government reporter, Sudi Rajan Sen, joins us now from New Delhi. Sudi, it's interesting, right? We'll talk about your big take in a bit. I just want to focus on the latest about Modi being able to form this coalition government. What comes next with this coalition? And certainly, can they adhere to some of these economic policies of a manufacturing boom, a infrastructure upgrade like Modi had promised?
Well, what comes next is as far as we can see, is a lot of compromises that Prime Minister Modi will have to make in this term. It's not, a simple majority that he has got, and therefore he needs the support of the alliance partners to survive. The life of his government depends on the pleasure of his partners. Mind you, there are not many partners in Indian politics today who want to team up with Prime Minister Modi. So it will be difficult if he has to go, shopping for allies, shopping for members in the parliament. That's one. Therefore, what we can expect very clearly, controversial issues, social issues in particular, controversial economic issues in particular. The allies may not want him to go through with it, and therefore that compromise will come. Now, what are the controversial issues socially? Of course, India is trying to bring in a uniform code for inheritance, because in India the inheritance code or the inheritance laws are largely on the religious lines to accommodate minorities. The BJP has been saying they wanted to remove that. It's unlikely that he'll be able to push through that. Similarly, other mapping of the population, which many in the opposition feel is going to discriminate against the minority, that may not go. So those are on the social front. If you look at the economic front, land reforms is something that is unlikely, again, because Prime Minister Modi tried it once, and when his popularity was at its peak, but even then he could not get the states to kind of agree to those kind of reforms. Labor reforms is something that is again going to perhaps not be palatable, or in the manner that the government wants to do it. They may have to compromise on that. So what we can clearly say that in the next, however long the government lasts, there will be series of compromises that we will see from the Prime Minister and his government.
And that takes us perfectly, Sudi, into the big take today. Fantastic work, by the way, to you and the rest there for putting this together. It's a reminder, I guess, some of the things that they weren't able to achieve the second time around. It's a reminder that there have been winners and losers, really, to this, right? They've created a billionaire elite. to some extent, there's been a massive group of people that have been left behind. And I'm wondering, is there something that is achievable from Modi's perspective with the mandate that was given that allows them now to bridge that gap and reach out to the segment of the population that feel, rightly or wrongly, they've been left behind?
Well, yes, I mean, because both the coalition partners in the government that we see, have socialistic ideologies, socialistic backgrounds in their politics, and therefore the pressure or the compulsion would be on the government would be to increase the welfare net. Now, increasing the welfare net is likely to immediately impact government spending. Already, India has the world's largest free food program. About 800 million people dependent on the free grains that the government gives out. But at the same point of time, it seems that it's not just that wasn't enough, because when we were out in the field, my colleagues were out in the field, one of the things that kept coming back, yes, free grains, fine, but what about other stuff, other important stuff like fuel, like edible oil, everything going through the roof, and there are no jobs that are there. So while the Prime Minister is trying to kind of push and take advantage of the US-China freeze and attract more manufacturing, more capital into India to manufacture and therefore generate jobs, that generation of jobs is another thing that Modi 3.0 is something which will bother them.
And you mentioned about this sort of Hindu nationalistic sort of agenda that he campaigned on, which in some ways, he's called himself an avatar of God, displaying some, unstatesmanlike sort of behavior that did alienate some of these voters out there. How do you think he's going to have to govern moving forward now?
Well, for one, we know in the last 10 years, the Prime Minister is a good communicator, great communicator, and he has got a connect with people. He still remains one of the most popular leaders that India has said. Many people still, despite the election results, still say that perhaps he's the best that India has. How does he recover? I don't see a need for him to recover. I mean, people over time will forget and things will move on. So, I mean, what we can see from the ground is perhaps that's not going to be a major embarrassment or a dent, and it'll be kind of taken as a political rhetoric during election time. So people will tend to ignore, unless and until, of course, we see more of these remarks and more, in a coalition government, Prime Minister Modi trying to assert himself, which his coalition partners may or may not like. So that is the time when these issues will come up. But right now, doesn't seem to be. Doesn't seem that it will be an issue going forward.
Sudhi, thank you so much, Sudhi Ranjan Sen there, our Bloomberg government reporter. And of course, you can read the full Big Take article that he and his team put out there in our terminal or online at Bloomberg.com.
Yeah, and you can also get more analysis on India's election results from today's webinar. In fact, begins right about now. In fact, so you can catch that, of course. So our colleague Menaka Doshi will be digging into really what went wrong. In some ways, the implications of what's been happening there, certainly for the economy. So joining her is, there we go, Ian Bremer out of Eurasia, and of course JP Morgan Securities, Rajiv Batra, all surrounding that webinar. So stay tuned for all of that just ahead. Right. Coming up, we will be shining a light on the challenges, a medal to whoever wrote the script here, facing the solar power sector as it gets caught up in the grand geopolitical game. More next with Bloomberg Opinion. You're watching The China Show.
We're checking some of these industrial metals here this morning, likes of copper, likes of iron ore. Continue to see maybe a bit of a retreat here, right? So we basically have pulled back from the record highs that we saw in copper prices. You're starting to see signs that maybe demand in China is weakening, right? When you take a look at inventories, for example, those are starting to pile up, not just when it comes to copper, but also iron ore as well.
It's a telling sign, right?
Yeah.
So I think earlier this year, given the sort of pronouncements around policy has really driven up inventory, right? So people have started buying, and certainly that's driven up, in cases, of course, futures tend to overcorrect one way as well. So to Yvonne's point, we are starting to see things actually piling up in some of these warehouses. Of course, we have a full piece on that, of course, just out as well. So it's not just copper, Yvonne's point, of course, iron ore, which might be telling and might also go into this note out of Fitch, which came out earlier on in new home sales, right? The new builds coming through might not get that inventory drawdown that most people were expecting just what, 4 or 5 weeks back.
Steel demand just not quite there at this moment. Let's talk a little bit more about not just industrial metals, but also when it comes to the solar space as well. Some Chinese solar firms are halting production at Southeast Asian factories as Washington steps up actions to protect its domestic market. Now, Longi Green Energy says it's making adjustments to its plans following reports that it started slowing activity at plants in Malaysia and Vietnam. There's another company as well, Trina Solar, is shutting capacity in Thailand and Vietnam in part due to U.S. demand. Let's bring in our Bloomberg Opinion columnist, David Fickling. He has a column out this morning saying that the speed of the energy transition could easily make people underestimate the scale of the challenge that lies ahead. He joins us now. David, always great to have you in the program. You're saying that President Biden, when it comes to U.S. policy, is wrong to say that we have too many solar panels. Why is that?
Yeah, I mean, I think you can look at 3 of the major statements that he's made on this and sort of fit them together and see why there's a bit of a disjunct. I mean, one promise is that the US grid will get to zero emissions by 2035. A second one was this announcement made at the G20 by the US and China last November, that there was going to be a tripling of the amount of renewable power in the world by 2030. And then finally, as you refer to, is the commentary about the sort of Chinese clean tech industry, that it's suffering from this sort of predatory overcapacity, pushing prices artificially low, more panels and batteries than the world can need. Now, the 3 of those don't really fit very well together. I mean, there has been this very rapid increase in renewables in recent years, so it's easy to assume that we're actually close to getting to those targets. But actually, if you look at some of the numbers, this is not overcapacity. This is just the basic capacity that we need, and actually not even as much capacity as we do need to hit those targets of tripling renewables by 2030 and getting a net zero grid in the US by 2035.
Okay, well, there we go again with longer-term projections, David, and not you. Certainly, whenever I hear, though, someone try and quantify how much money is needed, the job at hand, they lose me immediately with a big number. And I'm wondering now, do we have a better idea of what we need to, where we need to be, and whether or not we're capable of then building towards that objective?
Yeah, I mean, funnily enough, the International Energy Agency this week did an analysis of this, and I'll try and not use too many big numbers, but the amount of renewable power in the world at the moment is about 4,000 gigawatts, 4,000 nuclear power stations equivalent. That's roughly doubled over the past 7 years, and it needs to more or less triple, as we see this tripling, over the next 7 years to about 11,000 gigawatts. Now, we're not producing nearly enough to get to that. That was the main conclusion of the IEA's report this week. And if you look at the capacity that's out there, the numbers look very big, but really we've got capacity to produce about 800 gigawatts of solar panels and about 150 gigawatts of wind power. So that totals a little bit less than 1,000. And of course, we need about 7,000 over the next 7 years. So we barely have enough. We certainly don't have enough wind power. And if you look at those announcements that we were just talking about just before this about some of the closures of solar facilities in Southeast Asia and some of the troubles that the Chinese solar industry is going through, if you factor in a lot of that stuff, we're still, as the IEA argued this week, we're still well below the capacity that we actually need.
So what can the U.S. do then, David, to turn this picture around? I mean, barring lifting tariffs, but what else can they do?
Well, I mean, I think there's lots of stuff. If you look at the Inflation Reduction Act, there is lots of stuff that relates to exactly what they need to do, and there is a very broad spectrum operation coming out of Washington to solve this, with things like clearing up permitting. The amount of renewables waiting to get connected to the U.S. grid is greater than the amount of generating capacity on the U.S. grid as a whole at the moment. So there are these huge bottlenecks, a lot of which are to do with permitting, are to do with grid grid access and that sort of thing, some of which are to do with finance. But you can't ignore the tariffs issue. It's clearly something that's not going to change. It's an election year issue, and it's not going to change imminently. But ultimately, the US installed about 33 gigawatts of power, of renewable power last year. It's about 1/10 of what China did, and it needs to really increase that rapidly to get to this 2035 net zero.
David Fickling, thank you so much. Our Bloomberg Opinion columnist just taking us through there, of course, his latest piece. Yvonne.
Yeah, some top corporate stories we're following for you. Saudi Aramco is lowering prices for all of its oil to Asia next month, the first reduction that we've seen since February. Now, a pricing sheet says a flagship Arab light crude will be cut by 50 cents to $2.40 a barrel above the regional benchmark. It comes after OPEC Plus members, including Saudi Arabia, agreed to gradually roll back voluntary supply cutbacks starting in October. Boeing Starliner capsule is finally taking 2 NASA astronauts to space after years of delays and cost overruns. It's on track to dock with the International Space Station on Thursday. NASA is using the flight to prove Starliner can safely carry people to and from the ISS under the agency's Commercial Crew Program.
Yeah, well, that probably isn't junk. We're talking about a Boeing Starliner here. But here's the thing, though. When you look further up, there is plenty of stuff up there that actually is junk, right? So this Japanese company has actually plans to clean up all the trash in our planet's lower orbit. It actually made its trading debut in Tokyo this week, and its founder, Nobu Okada, has actually told us more how they plan to do all of that.
The funds will be put towards research and development as well as working capital, as we did with the previous funding. We're currently demonstrating our rendezvous and proximity operations technology in space. This technology is the foundation for 4 businesses we're developing. The money from the IPO will help us push through our R&D in these areas.
There's still a high level of uncertainty in this business. You yourself are still years away from cleaning space junk. Why is now a good time to invest in Astroscale?
The threat of orbital debris remains unpredictable. That's why it's important to act now. We already know that orbital sustainability will become impossible if we don't tackle the rapidly growing number of satellites, space debris, and junk. That's why we're taking the lead in developing the RPO technology and creating business models. Our work is contributing to creating the global rules.
You've said you want to win business from the private sector, not just governments and space agencies. Why would a private company care enough to pay you to clean up space debris?
We're fielding contracts for projects worldwide, mainly from government agencies. In space, the risks are high, but the rewards are low. That holds true for the private sector, too. We need to turn around the trend. Orbital services can do that. That's why we see a lot of interest from the private sector.
As we wait for updates on the Astroscale mission, what's your next milestone?
So, the 4 business areas I mentioned earlier, they are end-of-life services for retired spacecraft, life extension and inspection of satellites, and active removal of debris. Our next big step is to demonstrate the value of these space capabilities to the clients in the fiscal year 2028.
And why are you so passionate about solving this problem of space debris?
When I first heard about the space debris problem 11 years ago, I started this project immediately. Back then, nobody had a solution. I saw a good business opportunity, but I also felt a sense of duty, that someone had to solve this environmental problem. I considered this venture as my final gig in life.
What are your hopes for this IPO and this stock now?
The issue of space sustainability has become a truly global and urgent one. There's no time to waste. I hope to see many take an interest in the issue of space debris and the environment.
And that was the Astroscale founder, president, and CEO Nobu Okada speaking with Kurumi Mori there. We got plenty more ahead. This is Bloomberg. Here's your China Brief today. A look at what's making headlines in national newspapers. And the Securities Times says the issuance of new local government special bonds picked up in May, with more bonds to be issued in the future at the same pace. Meanwhile, the China Securities Journal sees a low chance, though, of a major PBOC tightening in June. They're citing experts. The paper says the overall stability of money markets has not changed, with the PBOC continuing to replenish liquidity in the financial system and keeping funding at appropriate levels. Another article in the paper sees that some progress in China's real estate whitelist project, and it says the third batch of screening is underway in some regions, including Guangdong, with a focus on supporting unsold residential projects.
Okay, let's have a look at markets right now. So we're doing quite well, if I'm being completely honest, with the exception of a couple of pockets of weakness, right? So in terms of market caps, a property's not really a very big points contributor anyway. So given the bear market that we're probably going to enter by the end of the day, it's not going to really go as noticed, apart from headlines, of course, as far as the overall benchmark is concerned. So, in fact, when you look at the actual benchmark itself, MSCI Asia Pacific, we're up 1.2%. Ex-Japan, which is on the lunch break, we're up 1% there. Your big heavyweights of the day, like TSMC, are really pushing this envelope quite substantially, 1.2%. So, you know what really drove this market high? Computex this week. All the information coming out. Really big newsmaker there.
Yeah, not just when it comes to NVIDIA. I think AMD, Lisa Su's speech as well, really kind of, brought a lot more on the table here in some ways. And it brings us to what's coming up next in terms of the event risk, and it's really the ECB. Because if they're really projected to cut, and if they do cut, I think that's a bit of a non-event.
Yeah.
I think it's really kind of what they lay out in the guidance, right? And if it does come out dovish, saying signaling more to come, what does it mean for euro-dollar, right? We've been basically stuck in a range for euro-dollar for 18 months now. Vol has been in the FX markets has been low.
Very low.
Are things going to start waking up? And how much could these rates can really tumble from here in Europe, too?
And with the equity market side to the equation, too, right? Because this is, they've telegraphed it enough that arguably you could say it's in the price already.
Yeah.
In the equity markets, right? So Stocks 50's done well. DAX has done very, very well, for example. The FTSE, well, not related to this specifically, but, that group of equity markets have done exceptionally well this year.
Yeah. But if you have a dollar that reemerges as stronger, that's going to have implications globally, right?
Well, you have the Fed next week.
Yeah, the Fed next week. So if we see that reemerged dollar strength, that's going to impact, currencies around the world, especially when it comes to China. We talk about, there's a great piece talking about the beta that the euro has on global currencies. So that policy decision could be pretty key here later on today. This is Bloomberg.